that they will henceforth not provide data on Indian indices or stocks to any foreign exchanges. This move makes it impossible for the Singapore exchange to keep offering derivative on the Nifty 50. Prashant Nair joins us now. Prashant, this comes as a huge blow to the Singapore exchange, which is in fact a hub for offshore trading for many markets. What will the SGX do now?
There are a couple of points of impact here. First of all, consider this. 52% of total trading activity which happens in Nifty futures, onshore plus offshore, happens offshore, happens in the SGX, happens in the Singapore Stock Exchange. So it tells you very clearly that that route was extremely popular. The instrument was extremely popular. Why is that? Taxes. I mean, people don't like to pay taxes. If you traded in the Singapore Stock Exchange, the Nifty instrument, there was no short-term capital gains tax, whereas authorities would very clearly want foreigners to trade in India and pay taxes in India. What will SGX do now? In a call with investors, what the Singapore Stock Exchange essentially is saying is that they may launch a new derivative product to ensure continuity. We don't know what that is going to be. Is it going to be in consultation and agreement with the NSE at some future point? We don't know. They're also saying we will develop solutions from NSE's Gift City. I mean, again, we'll see what happens there. I mean, the Gift City where there are exchanges there. And they also say that they can continue to offer trading on single stock futures. The exchanges here, etc., really differ on that particular point. But the SGX and the call said that according to their understanding, since there is no licensing issue, they can continue to offer products on that one. What happens to the MSCI India index? I mean, basically, the rule says that any index in which Indian securities form 25% more or 25% or more of weight, and that index is offered for trade outside of India, I mean, that basically is going to be null and void. We're not going to offer data to those indices. The good news is, the good part is that India is only 9% of the MSCI Emerging Market Index. Threshold is 25%, so there is no impact, which means MSCI India index will continue to remain relevant, but trading in MSCI India futures may have to stop. No confirmation from MSCI at this point, but that's the understanding from my conversation with market participants. Market impact locally, I mean, the stock market here was in fine fettle. The impact was on the Singapore Stock Exchange. The stock is traded, that fell. But back in India, foreigners who want to come and trade in India will have to register directly instead of looking for instruments like the SGX Nifty, which may not exist post-August when the notice period really ends. And this may also give a push to the Gift City, where the budget exempted people trading there from paying capital gains tax. Back to you.